Hello friends, good morning, good afternoon, good evening, whenever you're watching or listening to my channel NSR Audiobooks. Welcome back to my channel. Let's roll up to next topic. Financial resilience refers to the ability to withstand and recover from financial setbacks, challenges, or unexpected events without experiencing significant negative impacts on one's financial well-being. Here's how the concept of achieving financial resilience is discussed in The Psychology of Money. Emergency fund. The book emphasizes the importance of having an emergency fund as a key component of financial resilience. This fund acts as a financial safety net to cover unexpected expenses, job loss, or income disruptions without relying on high-interest debt or depleting long-term savings. Diversification. Housel discusses the role of diversification in building financial resilience. By diversifying investments across different asset classes, e.g., stocks, bonds, real estate, individuals can reduce the risk of significant losses from market downturns or economic fluctuations. Adaptability. Achieving financial resilience involves being adaptable and flexible in response to changing financial circumstances. This includes adjusting spending habits, lifestyle choices, and financial plans as needed to align with current income levels, goals, and priorities. Long-term perspective. The book advocates for adopting a long-term perspective in financial decision-making as a strategy for financial resilience. This involves staying focused on long-term goals, avoiding impulsive decisions based on short-term market movements, and maintaining discipline during periods of uncertainty. Risk management. Housel discusses the importance of effective risk management in achieving financial resilience. This includes assessing and mitigating risks associated with investments, insurance coverage, and overall financial planning to minimize the impact of unforeseen events. Emotional intelligence. The concept of emotional intelligence is also relevant to financial resilience. By developing emotional resilience, managing stress related to financial challenges, and avoiding emotional decision-making, individuals can enhance their ability to navigate setbacks and maintain financial stability. In The Psychology of Money, the concept of an emergency fund is discussed as a foundational aspect of financial planning and resilience. Here's how the book explains the importance and role of an emergency fund. Financial safety net. An emergency fund is described as a financial safety net that individuals can rely on during unexpected expenses, income disruptions, or financial emergencies. It serves as a buffer to cover essential expenses without resorting to high-interest debt or liquidating long-term investments. Peace of mind. Housel emphasizes the psychological aspect of having an emergency fund, stating that it provides peace of mind and reduces financial stress. Knowing that there's a cushion to fall back on in times of need can alleviate anxiety and help individuals make more rational financial decisions. Size and purpose. The book discusses determining the appropriate size of an emergency fund based on factors such as monthly expenses, income stability, and personal risk tolerance. It advises setting aside enough funds to cover at least 3 to 6 months' worth of essential expenses, liquid and accessible. Housel stresses the importance of keeping the emergency fund in liquid and easily accessible accounts, such as savings accounts or money market accounts. This ensures that the funds can be accessed quickly when needed without penalties or delays. Regular contributions. The book encourages regular contributions to the emergency fund as part of a disciplined savings strategy. It suggests automating savings by setting up automatic transfers from income to the emergency fund to ensure consistent growth over time. Financial resilience. Having an adequately funded emergency fund is portrayed as a key component of financial resilience. It allows individuals to weather unexpected financial shocks, job loss, medical emergencies, or major life events without jeopardizing their long-term financial goals. In The Psychology of Money, diversification is discussed as a fundamental principle of investment strategy aimed at reducing risk and maximizing long-term returns. Here's how the concept of diversification is explained in the book. Risk reduction. Diversification involves spreading investments across different asset classes, industries, geographic regions, and types of securities. The primary goal is to reduce the overall risk of a portfolio by not being overly concentrated in a single investment or asset class. Asset allocation. The book emphasizes the importance of strategic asset allocation as a form of diversification. This includes allocating investments among stocks, bonds, real estate, cash equivalents, and other asset classes based on individual risk tolerance, investment goals, and time horizon. Market volatility. Housel discusses how diversification helps mitigate the impact of market volatility and fluctuations. By holding a diversified portfolio, investors are less exposed to the risks associated with individual stocks or sectors, making it easier to weather market downturns. Long-term performance. The concept of diversification is tied to long-term performance and wealth preservation. Housel advocates for maintaining a diversified portfolio over time, rebalancing periodically to align with investment objectives, and avoiding the temptation to chase short-term gains or speculative investments. Psychological benefits. Diversification also offers psychological benefits by reducing the emotional impact of market swings. Housel highlights how a well-diversified portfolio can help investors stay disciplined during periods of market turbulence, avoiding panic selling or impulsive decisions based on fear or greed. Asset correlation. The book touches on the importance of considering asset correlation when diversifying investments. Assets with low or negative correlations can provide additional diversification benefits, as they may not move in tandem with each other, reducing overall portfolio risk. In The Psychology of Money, adaptability is discussed as a crucial trait for financial success and resilience. Here's how the concept of adaptability is explained in the book. Flexibility in financial planning. Adaptability in financial planning involves being flexible and open to adjusting financial goals, strategies, and decisions as circumstances change. This includes being responsive to changes in income, expenses, market conditions, and life events that may impact financial stability. Embracing change. The book emphasizes the importance of embracing change and uncertainty in financial matters. Housel discusses how adaptability allows individuals to navigate unexpected challenges, economic shifts, and market fluctuations without derailing long-term financial plans. Adjusting risk management. Adaptability extends to risk management strategies, such as modifying asset allocation, diversifying investments, or adjusting risk tolerance based on evolving financial goals and market conditions. This ensures that investment strategies remain aligned with changing circumstances. Learning and growth. Adaptability involves continuous learning and personal growth in financial matters. Housel encourages readers to stay informed about financial trends, investment opportunities, and evolving strategies to make informed decisions and adapt to changing financial landscapes. Psychological resilience. The concept of adaptability also includes psychological resilience, such as maintaining a positive mindset, managing stress related to financial challenges, and avoiding emotional decision-making during periods of uncertainty or volatility. Long-term perspective. Housel emphasizes the importance of maintaining a long-term perspective while being adaptable. This involves focusing on long-term financial goals, avoiding reactionary decisions based on short-term market movements, and staying disciplined in financial planning and investment strategies. In The Psychology of Money, a long-term perspective refers to the mindset and approach towards financial decisions that prioritize sustained growth, resilience, and goal achievement over an extended period. Here's how the concept of long-term perspective is explained in the book. Focus on goals. Housel emphasizes the importance of setting and focusing on long-term financial goals. This involves defining clear objectives such as retirement savings, wealth accumulation, education funding, or financial independence, and making decisions aligned with these goals. Avoiding short-term thinking. The book cautions against succumbing to short-term thinking or chasing immediate gains. Housel discusses how short-term thinking can lead to impulsive decisions, market timing mistakes, and neglecting the compounding effect of long-term investments. Resilience to market volatility. Adopting a long-term perspective helps investors withstand market volatility and fluctuations. Housel advocates staying invested through market cycles, avoiding panic selling during downturns, and focusing on the overall trajectory of investments over time. Patience and discipline. Long-term thinking requires patience and discipline in financial planning and decision-making. It involves staying committed to long-term strategies, resisting the urge to make emotional decisions based on short-term market movements, and maintaining a consistent savings and investment approach. Wealth building and compound interest. The book discusses how a long-term perspective contributes to wealth building, particularly through the power of compound interest. By staying invested and allowing investments to grow over time, individuals can benefit from compounding returns and achieve significant wealth accumulation. Risk management. Housel addresses risk management in the context of long-term perspective, emphasizing the importance of balancing risk and reward over the long term. This includes diversifying investments, managing risk tolerance, and avoiding excessive risk-taking that could jeopardize long-term financial goals. In the psychology of money, risk management is a critical concept that involves assessing, mitigating, and effectively managing the risks associated with financial decisions and investments. Here's how risk management is explained in the book, Understanding Risk. Housel emphasizes the importance of understanding different types of risks in financial contexts, such as market risk, credit risk, inflation risk, and liquidity risk. This involves assessing the potential impact of these risks on investments and financial goals. Risk tolerance. The book discusses the concept of risk tolerance, which refers to an individual's willingness and ability to withstand fluctuations or potential losses in investment value. Housel advises aligning investment strategies with risk tolerance levels to ensure comfort and confidence in financial decisions. Diversification. Risk management strategies often include diversification, which involves spreading investments across different asset classes, industries, and geographic regions. Diversification helps reduce the impact of individual investment risks and market volatility on the overall portfolio. Asset allocation. The book touches on the significance of strategic asset allocation in risk management. This involves determining the appropriate mix of stocks, bonds, cash equivalents, and other assets based on risk tolerance, investment objectives, time horizon, and market conditions. Insurance coverage. Housel discusses the role of insurance as part of risk management. This includes having adequate health insurance, property insurance, liability coverage, and other types of insurance to protect against unexpected expenses, losses, or liabilities. Long-term perspective. The book emphasizes maintaining a long-term perspective in risk management. Housel advises against reacting impulsively to short-term market fluctuations or trying to time the market, as such behaviors can increase risk exposure and undermine long-term financial goals. Behavioral aspects. Risk management also involves addressing behavioral biases that can affect risk perception and decision-making. Housel discusses how emotions like fear, greed, overconfidence, and herd mentality can influence risk-taking behavior and offers strategies to mitigate these biases. In the psychology of money, asset correlation refers to the degree to which the prices of different assets move in relation to each other. Here's how the concept of asset correlation is explained in the book. Positive correlation. Assets that are positively correlated tend to move in the same direction. For example, if one asset's price increases, the prices of positively correlated assets also tend to increase. The book discusses how positive correlation among assets can increase portfolio risk, especially during market downturns when correlated assets may decline together. Negative correlation. Assets that are negatively correlated move in opposite directions. When one asset's price increases, the prices of negatively correlated assets may decrease. Housel explains how negative correlation can be beneficial for risk management and diversification, as it can help offset losses in one asset with gains in another. Zero correlation. Zero correlation implies that there is no predictable relationship between the prices of two assets. The book touches on how zero correlation can provide diversification benefits, particularly if the assets have different risk profiles or respond differently to market conditions. Diversification benefits. Housel discusses how understanding asset correlation is essential for diversifying investments effectively. By including assets with low or negative correlations in a portfolio, investors can reduce overall portfolio risk and enhance resilience to market volatility. Correlation coefficients. The book may delve into correlation coefficients, which quantify the degree of correlation between assets. A correlation coefficient close to +1 indicates strong positive correlation, close to -1 indicates strong negative correlation, and close to 0 indicates no correlation. Practical applications. Housel may provide examples or case studies to illustrate the practical applications of asset correlation in investment strategies. This could include discussing how diversifying across asset classes, with different correlation profiles, can improve risk-adjusted returns and portfolio stability overall. The psychology of money likely emphasizes the importance of considering asset correlation when constructing investment portfolios. By understanding how different assets behave relative to each other, investors can make more informed decisions, manage risk effectively, and build resilient portfolios that align with their financial goals and risk tolerance.